Welcome to the Midwest Moguls Show, where we talk all things business, real estate, and entrepreneurship. Let's dive into today's episode and make business enjoyable again.
Welcome back to another episode of the Midwest Mogul Show. It is your host, Carter Crowley here, and today is another Friday deal breakdown. Specifically, what we are talking about is seller financing, getting owners to accept terms for their property, for their business, honestly, for whatever you want to buy and not come out of pocket with all of the cash in order to buy it. So we're going to dive into the details on how you should present your offer, the questions that you should ask the owner that you're dealing with, so you win more deals than you lose out on, and you ultimately capitalize on more opportunities. So if you guys have questions, though, remember, if you're watching this on YouTube at Carter Crowley, just drop a comment down below. If you're listening to the audio feed, shoot me an email, carter@flipfoxvalley.com. But diving into this, so first, let's go over what is seller financing. Seller financing is when an owner acts as a bank, meaning they agree. So like any bank, for example, you get a mortgage on a property, you agree to pay them some sort of down payment, some sort of monthly payment for an explicit amount of time, or until the property is completely paid off, or until the loan is completely paid off. Example purposes, you get a car, it's a 5-year loan, you put down $2,000, you're agreeing to pay $500 a month for the next 5 years. At the end of 5 years, it is paid off. Very simple, very easy. Most real estate investors, or most even wannabe like business owners who are trying to acquire businesses, they're not necessarily familiar with this. But from an owner's perspective, it is favorable when it comes to taxes, income tax mainly, and should be something to be considered, especially if they own the item that they're looking at selling, free and clear of any and all debt or liens or encumbrances. So diving into seller financing, when it might be used, why it might be used, the common circumstances. So the first one that I already went over, when a property is owned free and clear, that is a very high likelihood that you should offer some sort of seller financing. I would at least recommend to do it, especially if you're looking at holding this as a rental property. So in our scenario right now, to give you some context, we own storage units on seller financing. We own single family houses on seller financing. I'm going to go over this Friday deal breakdown on a package of single family houses that we bought. We own duplexes. I'm trying to think of what else. We just bought a garage, a storage building. Yeah, that's kind of the gist of it as of right now. And these terms range from 3 years to 7 years to kind of everywhere in between. So it's very flexible. So for rental properties, this is a phenomenal strategy, especially if you want to limit the amount of money coming out of pocket and you want to have a negotiable payment with the owner. And ultimately, if you want to get a better deal than going through a traditional bank or a lender for the specific asset that you are looking at purchasing. So in the scenarios that we have used seller financing on our side, they have been real estate related. Now, the real estate assets that we've bought, for example, storage units, this 10 property package down in Milwaukee, which again, I'll break down in just a second on my screen. I'll walk you guys through all of the numbers and how I arrived at them. But for those specific scenarios, an owner is set on typically a specific price that they want to have at the end of the day. And if we were to do an outright cash purchase, numbers just don't financially make sense. Or if we were to acquire bank debt, numbers don't financially make sense. So I always broach the topic or broach the question. It's like, hey, Mr. or Mrs. Owner, obviously you want $900,000 for this particular property or this set of properties. We cannot do that going through our normal bank. It wouldn't cash flow. It wouldn't financially make sense for us. The numbers don't add up. But have you ever considered financing them on your side if we were to provide like a down payment, monthly payment sort of scenario for a certain amount of time? That's the exact question that I ask. Some people are going to be like, no, there's no way I would do that. Some people will be like, hey, I wouldn't be opposed to the idea as long as you send over some ideas. And on my side of things, that's our specialty, presenting the offer, giving them a certain set of criteria or numbers to go off of because they might not necessarily know what they want, but if you break it down for them in an easy to digest fashion, you are going to have a lot higher likelihood of success. In every single seller financing scenario that we present, we give them 4 to 5 different options when it comes to pricing, when it comes to payments, everything and anything in between. And that's why I like seller financing so much. And the other reason being, honestly, you can make the terms whatever your heart desires. We have now 2 properties, 0% interest. We're just paying down the principal on the loan. You're never going to get that from a bank. It's literally principal only payment. So if we pay $1,500 a month, the principal is reduced by $1,500 per month. Kind of phenomenal. These terms range from, again, 3 years, 5 years, 7 years, 10 years, and they're fixed for that amount of time, which with commercial financing, normally it maxes out at about 5 years. With seller financing, again, you can pick and choose whatever your heart desires or whatever you and the owner agree upon. That's, again, why I love it. And all of our seller finance properties, we have brought less than 20% down to the table in order to secure the asset. Most recently, we're buying this Milwaukee package. Let me just do some quick math for you guys while I'm doing this. So the purchase was, we had 5% down payment. I think we actually might have brought a little bit more. We might have brought 8 or 9% to close, but that's a lot less than 20% down in a traditional commercial mortgage or a traditional residential mortgage for investment property. That is why you should be presenting seller finance options. And to some of the owners, down payment, if they request a 20% down payment, and then I'll dive into the details on the deals here shortly. But if they request a 20% down payment, that I always come back with the objection handler. It's not really an objection, but I'm like, hey, Mr. and Mrs. Seller, honestly, if we're going to do a 20% down payment, we might as well just go to our bank in order for them to finance it for us because they have all of our information already. I'm not really interested in doing 20% down. We can present you with some other options with a lesser down payment, but for right now, we always like to keep our cash in circulation. So the less that we have in the deal, the more competitive it is for us and the more financial sense it makes for us. And then I just move on. I go to the next topic because I don't even let it, it's not an option for us. We're not putting 20% down on property. It's as simple as that. And if you're confident in that decision and you're confident in the language that you're using to talk to these owners, they will trust you moving forward. And all seller financing it is a relationship number one. If you do not have a relationship with the owner, you will not be able to negotiate seller financing. That's where a lot of these, you have to meet them in person. You have to build that trust. They have to be willing to trust you because you are agreeing to make them payments every single month on time for the next 3, 4, 5, 6, 7 years in a row. If they don't trust you, chances are it's probably not going to work out. Or unless they're in a desperate situation, then they might be willing to do it. But there's an inherent risk to them that you're going to default on the loan. Now they have to go through the foreclosure process, take it back. Even if you did make improvements, it's very inconvenient. And a lot of these owners are a little bit older who are willing to do this since they do have the property free and clear. But let's dive into this. I'm going to share my screen. So if you guys are listening only on the audio feed, I'm going to break things down for you in as much detail as I can. If you're listening or you're watching on YouTube, this is going to be extremely beneficial for you. Okay, let's break this down together. So you can see right here, this example situation is for a Milwaukee package of 10 properties. This is just the sample letter of intent that I have with multiple options. Again, if you guys want this sheet, I can of course send it to you, carter@flipfoxvalley.com. Just shoot me an email. Otherwise, you can pretty much read it, kind of type it into your computer, and then you'll have the same exact one. But there's no rhyme or reason behind this. I've just built this out over the years. So you can see here, the first option, outright purchase, cash purchase. By far, always going to be the lowest option. This is at a phenomenal deal for us, not for the owner. This is a phenomenal deal for us. So in this situation, for a package of 10 properties, we had $773,400 for 10 properties. So averaging out about 77 grand per property. ARVs on these places are probably 185 to 200 once they're fixed up. So we would be getting them at cents on the dollar, less than 50% of cost. Now, close in 30 days or the date is the seller's choice. This is all included in option number 1 if you guys are listening. So it just has bullet points. So the purchase price, $773,400, close in 30 days or seller's choice. Buyer would pay all the closing costs, no commissions, fees, inspections, or repairs needed. And then buyers would require a walkthrough of properties prior to closing. We included that in this option because this was a sight unseen offer contingent upon walkthrough. Because coordinating 10 different walkthroughs with 10 different tenants is not the easiest scenario. And again, most owners, especially seller finance, they want to know if you're serious in advance of going under contract. And that's why the letter of intent is the most valuable tool you have when you're acquiring like commercial assets or multiple properties all in one. And the letter of intent is non-binding. This is literally, what is it? It's just options. It has a spot at this one doesn't even have the spot at the bottom for the seller to sign or the option that they would like to go with. We just went via conversation with this owner. Now going into option number 2, payments. And I have 4 different breakdowns for the payments option on our side. So the number 1 for the payment section, which is seller financing or land contract in this case, it was an $840,000 purchase price, 8% down, which is $67,200, 5% interest rate, better than what a commercial lender is at. They're at like 6.75 right now. Payment was based upon a 25-year amortization. Our bank sometimes lends at 20-year amortizations. Sometimes they'll go up to 25, but it's not super common. And this is for a fixed 4 years. So again, all of these items are better than what our specific commercial lender can do. Net benefit to us. So that's an $840 purchase price. Option number 2 under the payment section, an $870 purchase price. So literally the first option is, what is that? $67,000 higher than our cash purchase for land contracts. So that's why it's intriguing to an owner. Then our option number 2 under payments is at $870,000, roughly $100,000 higher than our cash purchase. Again, 5% down payment on $870,000, which is $43,500. Where are you getting that? You're not getting that anywhere. Interest rate 4%. Again, extremely competitive. We haven't seen interest rates at 4% in years. Payment based upon a 25-year amortization in a term of 5 years. And then option number 3, which is actually the option that this particular owner went with, was a $900,000 purchase price, 5% down payment. We actually had a 1031 funds, which I'm not even going to get into in this video. So we gave him more of a down payment, but that was just based upon necessity on our side because we had to roll everything over. So he went with option number 3, which is $900,000 purchase price, 5% down. Again, he got a little bit more. Interest rate 6%, still better than what commercial loans are at right now. Payment was based upon a 30-year amortization on a commercial loan. Not heard of. This is absolutely not heard of. Normally, again, they're 20 to 25 at the most. Fixed for 7 years. Again, not heard of. It's not possible. You cannot get a commercial loan like that, at least in my experience, for those specific terms. That down payment, that monthly payment, that amortization schedule, that interest rate. So it's a net benefit to us. And then the 4th and final option, purchase price, $963,000, literally almost $200,000 higher than what our original cash offer was of $773,000. So a $963,000 purchase price, $63,000 higher than the other option, almost $100,000 higher than the first seller financed option. So this was 0% down payment, 0% interest, and $5,200 a month for 5 years. You give them all the different options. And honestly, I like the highest priced option with the 0% interest, 0% down payment, because we're making so much equity growth based upon principal alone. And if it's fixed for 5 years, so if we're paying $5,200 a month for 5 years, we would have paid off $312,000 in principal alone during that time. So that option honestly works out better than all the previous ones that I suggested. And that's why I'm much more willing, based upon like amortization schedules. And of course, I'm not going to get down into the nitty gritty in this video, but the 0% interest is so much better for your cash flow metrics, for the equity growth, that I would always recommend including one of those options. Again, if you're buying businesses, if you're buying real estate, it is vital that you include a 0% interest option, because you don't know what the seller is going to take. For them, the highest purchase price might be the best thing. They might want the most amount of purchase price possible. They also might suggest that you make a down payment in addition to that, which is fine. But if you're able to pay principal only on your mortgage or on a note, it is the best thing possible. And you don't know unless you present the option. So as I had mentioned, he chose option number 3, which is the $900,000 purchase price with the 5% down payment, 6% interest, 30-year amortization fixed for 7 years. Now the cash flow metrics on this, I'll just go break down the different options, and I did have to write this down on a sheet of paper. So I'm going to just go back to the solo layout here. But what ended up happening, so these were all in the Milwaukee area. Milwaukee got hit with a flood in 2025 that flooded a significant amount of the properties in the city. 9 out of 10 of these properties flooded out, which means new furnaces, new water heaters, mold remediation, anything and everything. We were able to negotiate prior to close a price reduction. I think the price reduction was roughly about $46,000, which was honestly a little bit light. We should have probably asked for more because it ended up costing us more in remediation and furnaces and water heaters, everything like that. And then we had issues after the fact as well from the tenants who were still complaining about, hey, there is some mold growth, so on and so forth. But we did get that all taken care of. But that $900,000 purchase price dropped down to about $855,000 after the price reduction. Our current loan on the place, and just doing quick math for you guys, so our current loan was at $785,000. So if we had an $855,000 purchase minus $785,000, we ended roughly about $70,000 down, which means, so 70 divided by $855,000, we made an 8% down payment based upon the 1031 exchange funds that we were rolling over. And our monthly mortgage cost on this particular place is $4,710 per month. The net cash flow from these particular properties, or the gross cash flow, is $12,000 per month. So our mortgage is $4,700. We're bringing in gross $12,000, and the portfolio in and of itself, because we've stuck well over $100,000 at this point into renovations, it's probably worth between $1.5 to $1.6 million. So the initial purchase price, $855,000, bunch of improvements. Now it's worth 1.5 to 1.6. Again, it's a phenomenal deal in our book. And this is a set of properties. It's fixed for 7 years. So we are going to hold this for the 7 years. Then we're going to take it to our bank, either refinance it or honestly sell them off. We're probably going to refinance them at that point. It's just going to be easier. And then we can kind of piece off the different properties that we don't want, if that's the route we end up going. But seller financing for this particular set of properties was the way to go. If we had to purchase them outright with cash, then we would have probably ended up taking them to our lender and getting a commercial loan on it, but we'd have still been paying more dollars per month if that was the case. And how I ran through our initial numbers on this, I always look at what is the potential, on the low side, potential gross rent. I want our mortgage to be about 35 to 40% of that amount. So however you can come up with that, use the mortgage calculator on your phone or use the payment calculator on your phone and figure out if it brings in $10,000 per month, you want your mortgage roughly about $3,500 to $4,500 is probably a safe estimate, because then you can factor in taxes and expenses and all the other stuff. Once you have that, then figure out what you're comfortable with for a down payment. My down payment, the less money, the better. Especially if you're going to have to make improvements to the business or to the real estate, you want to have adequate cash reserves so you can do this. You also want to factor in vacancy, in delinquency on tenants not paying on time, eviction costs, repairs, maintenance, property management. All of these different things should come into your final number. And you want to at least be earning per year a 20% cash on cash return. So for us, again, we rolled over 1031 exchange funds, but right now with the way things are at, we are earning about $300 per property. So we're earning about gross, or like net about $3,000 per month in cash flow, which adds up to, over the course of the year, $36,000. We had $70,000 down. So we're earning roughly a 50-ish% return on this deal. And that doesn't even factor in the equity growth that we're having. It doesn't factor in the equity at all. So our return on investment is an absolute home run for this particular deal, but we still need to perform on it. We still need to collect rent. We still need to satisfy the properties or satisfy the tenants or the residents that are living in the properties so they continually pay. We don't have any issues. We don't have any vacancy. We don't have anything like that. And managing properties in the Milwaukee area is not my strong suit. We have property management. We needed to do a better job of managing the managers, because there is some delinquency at the time of this recording, which sucks. Like, that is the biggest learning lesson. So our goal over the next 7 years, and this is just a long-term vision, 2033, our goal is to have 100 different places, 100 different properties, not 100 units, 100 different properties that provide high quality housing that is affordable, that a tenant will have pride of ownership and living in. So this means doing the big lifts, the big renovations on the front side, so the tenant is comfortable living there, they're happy, they're satisfied, they want to continually live there for the next several years. And we particularly like the 3-bed, 2-bed, 1-bath, single-family houses, or if they have more baths, fantastic. And we're trying to make them as maintenance-free as possible, so the cash flow is a lot more predictable. And then we can eventually start taking draws off the actual cash flow of the rental properties. So this was a Friday deal review and why seller financing is so important. And you can either set up one of these in a land contract form, which is what we used on this particular set of properties, or a seller financed mortgage. The land contract is probably better for the owner of the property. The seller financed mortgage is probably better for you as the borrower. Tax implications, again, I'm not an accountant, but they're roughly about the same, because it's based upon the tax implications are based upon the down payment and then the actual interest income they're receiving on a yearly basis. So again, talk with your CPA or have the owner talk with their CPA to get a better financial outlook on things. But that is the way the cookie crumbles in this deal. If you guys have questions, if you're interested in running through a different scenario, or you have a scenario that you're like, hey, what should I offer on this? Please do reach out, Carter@flipfoxvalley.com. Otherwise, I will catch you guys in the next episode. I appreciate you watching as always, and I'll talk to you later.